Welcome to this deep dive. So I want you to picture like a massive, heavy bank vault door swinging open,
Right.
but not with some loud alarm going off. It's happening in a complete orchestrated silence.
Which is pretty rare for this space, honestly.
Oh, totally. Because while the public internet is just out there endlessly screaming about, volatile meme coins and trying to time the top of the market, the people who manage the global economy's actual foundational wealth, they've kind of quietly slipped through the back door.
Yeah, they aren't arguing on social media.
Exactly. They just dropped $858 million onto the table in a single week.
It's wild. The contrast between that chaotic public narrative and the calculated institutional reality, it is just staggering.
It really is.
We're basically witnessing this historic structural reallocation of capital. Yeah. And it's happening entirely below the radar of your average retail observer.
Yeah, and we have an incredibly dense stack of intelligence to process for you today just to figure out why this is happening right now.
We really do.
We're pulling raw, granular market flow data from CoinShares. We're also breaking down the psychological mechanics driving these moves using behavioral finance models, specifically the ones pioneered by Daniel Kahneman and Richard Thaler.
Right. They're heavy hitters.
Exactly. And we're cross-referencing all of that with some really serious macroeconomic assessments from the Bank for International Settlements, the BIS, and the International Monetary Fund.
So the mission here is to basically reverse engineer this specific moment in financial history.
Yeah.
We need to decode why almost $1 billion moved in, 5 business days?
Yeah, just 5 days.
Right. And what this aggressive institutional maturation means for your understanding of, systemic risk, portfolio construction, and really just the underlying plumbing of global finance.
Okay, let's unpack this, because before we can analyze the motive, we really have to look at the sheer gravity of the scoreboard here.
The numbers are huge.
They are. The data avalanche from CoinShares paints this picture of just relentless accumulation. We are currently staring at the 6th consecutive week of net positive inflows into digital asset funds.
Yeah, which proves this is not just some weekend retail pump.
Exactly. The cumulative total for this recent streak is sitting at roughly $4.9 billion.
And that volume pushes total assets under management across the sector well past the $160 billion mark.
Wow.
To find a comparable period of sustained unidirectional buying pressure, you have to look all the way back to the April to July window of 2025.
And the composition of that capital flow tells the real story, I think. Because out of that $858 million weekly injection, about $706 million flowed directly into Bitcoin.
Lion's share, as usual.
Right. Then Ethereum grabbed around $77 million, and Solana took $47 million. But the true anomaly in the data, the data point that absolutely screams institutional strategy, is XRP suddenly pulling in $39 million.
Yeah, that stood out to me too.
Right. A $39 million inflow into XRP isn't just a random technical breakout. That tells me asset managers are actively pricing in the end of regulatory hostility. They aren't buying a technology narrative. They are buying a legal settlement narrative.
What's fascinating here is the specific mechanism these institutions are utilizing to execute these massive allocations.
Yeah, tell them about the mechanism.
Well, they're completely bypassing the crypto-native exchanges.
Right.
They are not out there managing private keys or, dealing with multi-signature wallets. This entire $4.9 billion flood is moving almost exclusively through regulated exchange-traded products and exchange-traded funds.
Which makes sense. So instead of thinking about this market like a trend, it's really more accurate to view it as a massive upgrade to a city's water infrastructure.
Oh, I like that analogy.
Yeah, for the last decade, crypto was this rushing, dangerous, unregulated river, right? Retail traders were out there with buckets just hoping they didn't get swept away by, a collapsed exchange or a frozen withdrawal.
Right, the Wild West.
Exactly. Wall Street looked at that river and decided, hey, we can't send our clients into the rapids. But over the last year, they've built this reinforced, heavily regulated concrete aqueduct.
The ETF.
The ETF is the aqueduct, yeah. The underlying asset is the exact same, but the delivery mechanism is finally up to corporate code. It comes complete with audited custody and legal recourse.
That infrastructure analogy perfectly captures the paradigm shift here. I mean, the friction of participation has been completely engineered out of the process.
Completely.
And the timing of this aqueduct going fully operational, it's directly tethered to a highly specific catalyst on the horizon. The capital isn't just moving in a vacuum,
Right.
It is actively front-running the May 14th Senate vote on the Digital Asset Market Clarity Act.
But wait, let me challenge that narrative for a second, though.
Go for it.
With Bitcoin currently trading well above the $80,000 threshold, we really have to ask if a single piece of pending U.S. legislation is truly the primary catalyst for a nearly $5 billion flood.
You think it's just price action?
Well, it seems highly probable that fund managers are just looking at that 80K price tag and experiencing like sophisticated institutional grade FOMO.
Panic buying.
Yeah.
Yeah.
I mean, they're terrified of sitting in front of their investment committees at the end of the quarter and having to explain why they entirely missed a double-digit yield in a major asset class.
Okay, I hear that. Price momentum undoubtedly accelerates the timeline, sure. But behavioral finance models suggest something much deeper is happening at the compliance level.
Really? How so?
Well, when we look at Kahneman and Thaler's prospect theory, specifically the concept of loss aversion.
Right, classic Kahneman.
Exactly. We see that institutional entities don't fear market volatility nearly as much as they fear unquantifiable ambiguity.
Oh, okay. Meaning like a chief risk officer doesn't necessarily mind if an asset has a historical drawdown of 30%, so long as their quantitative analysts can actually model the probability of that drawdown happening.
Spot on. But if the Securities and Exchange Commission could, theoretically designate the entire asset class as an unregistered security tomorrow,
The probability model completely disintegrates.
the math becomes totally impossible. And that existential legal ambiguity creates a massive risk premium.
Right.
Capital stays paralyzed on the sidelines because the potential for catastrophic regulatory ruin just drastically outweighs the financial upside of catching a bull run.
So the Clarity Act basically vaporizes that ambiguity.
Exactly. Even just the mere anticipation of clear statutory definitions for digital assets radically compresses that perceived risk premium. Kahneman actually documented this as the certainty effects.
Right, where people prefer a sure thing.
Yeah, demonstrating that decision makers will pay a massive premium to shift from a highly probable outcome to a 100% certain outcome.
Okay, so the fiduciary hurdle isn't the volatility of the asset itself. The hurdle is the paperwork.
Pretty much.
By establishing a definitive safe harbor, the Clarity Act actually satisfies the fiduciary duty to avoid unquantifiable risk. They are reacting mathematically to the disappearance of a regulatory black box.
And if we connect this to the bigger picture, the U.S. legislative environment is really just the trigger. The macroeconomic environment is the gunpowder.
Ooh, I like that.
The institutions funneling billions through these ETF aqueducts, they're playing a highly defensive global macro strategy.
Yeah.
The reports from the Bank for International Settlements and the IMF, they highlight this desperate systemic search for non-sovereign inflation hedges.
Yeah, because when a trillion-dollar asset manager evaluates the algorithmic scarcity of a 21 million hard cap, they are not evaluating a novel software feature.
No, not at all.
They're looking at a mathematical counterweight to the massive monetary expansion policies of global central banks.
Right.
In a high-interest, high-debt environment where fiat debasement just feels inevitable at this point, a decentralized asset with an immutable supply schedule transitions from, like, a speculative tech bet into a structural macroeconomic lifeboat.
Yeah, the predictability of the protocol is the ultimate attraction in a chaotic fiat system. However, the deep dive into the IMF and BIS papers reveals that these legacy institutions are looking far beyond just the static digital gold store of value thesis.
Which brings us to the next point.
Right. Their long-term strategy involves integrating the underlying distributed ledger technology directly into traditional capital markets.
Through real-world asset tokenization.
Exactly.
Here's where it gets really interesting, folks, because the evolutionary leap from just holding a Bitcoin ETF as an inflation hedge to actively tokenizing global markets that requires an oceanic level of liquidity.
Massive liquidity.
Yeah. Tokenization essentially is turning a physical commercial skyscraper in Manhattan, or say a traditional U.S. Treasury bond, into a programmable, fractionalized data structure on a blockchain.
Right, where a smart contract basically acts as the escrow, the title company, and the clearinghouse all at the same time.
Exactly. You create a globally liquid 2.47 market with instant atomic settlement. But if you want to execute trades of that magnitude without triggering massive slippage, the underlying blockchain needs to be absolutely awash in institutional capital.
And that deep liquidity we are observing right now, that $160 billion in AUM, is the mandatory prerequisite for that future state.
Right.
Economists refer to this as a network effect cascade. Massive capital inflows aggressively reduce historical volatility.
Makes sense.
And that lowered volatility profile attracts sophisticated, institutional-grade infrastructure developers. Those developers then build the secure rails that make large-scale tokenization mathematically and legally viable.
So it's basically the graduation of the asset class from an isolated speculative playground into the consolidated plumbing of global finance.
Exactly.
But, let's shine a harsh light on the warnings buried in these reports, because we can't just pretend this newly constructed financial aqueduct is completely immune to cracking.
No, definitely not.
The IMF and the BIS are the exact same institutions writing the rule books, and their assessments outline some pretty severe systemic vulnerabilities currently threatening this market structure.
Yeah, the reports do not sugarcoat the fragility of these inflows. Volatility has been dampened, sure, but has not been eradicated.
Right.
A single unexpected macroeconomic shock, say, a hotter-than-expected inflation print, or a sudden delay in the Clarity Act vote, or even a geopolitical disruption could trigger a violent, reflexive unwinding of that $4.9 billion.
Because capital that flows in easily through an ETF can flow out just as aggressively with a single mouse click.
Exactly. This is a double-edged sword.
Furthermore, the regulatory friction doesn't just vanish simply because the U.S. Senate passes a single piece of legislation. The decentralized network operates globally, which creates immense jurisdictional nightmares.
Oh, massive headaches.
We are talking about wildly divergent tax treatments across different sovereign borders and incredibly complex anti-money laundering complications. You have permissionless protocols interacting with heavily sanctioned geographic regions. And, traditional compliance software has not fully adapted to the reality of on-chain peer-to-peer settlement.
And beyond the jurisdictional friction, the CoinShares data exposes a glaring structural weakness, which is immense concentration risk.
Oh, the Bitcoin dominance.
Yeah. With over 700 million of that $858 million weekly inflow channeled exclusively into Bitcoin, the entire digital asset ecosystem is fundamentally tethered to the performance of a single asset.
Yeah. If Bitcoin experiences a sharp liquidity crisis, the correlation across the sector means diversification is largely an illusion.
Completely.
A 20% correction in the primary asset drags the entire market cap down with it. So what does this all mean for the fundamental valuation of the space?
That's the big question.
We have a market aggressively celebrating record-breaking AUM and an $80,000 price tag. But we have to question if the market is, dangerously confusing the influx of speculative institutional capital with actual localized day-to-day economic utility.
Well, this raises an important question, right? And the IMF explicitly centers its risk assessment on this exact vulnerability.
Okay, break that down.
Institutional investment is ultimately a leveraged bet on future utility. But the intrinsic long-term survival of the network is entirely dependent on its ability to solve mundane, frictionless, real-world problems.
Right. If the technology cannot facilitate, say, near-zero-fee cross-border remittances for a global workforce,
or provide a secure, decentralized identity protocol that grants banking access to the unbanked,
then the structural foundation is just hollow. It's just resting on the momentum of ETF flows rather than actual economic velocity.
Exactly. The overwhelming consensus from these macroeconomic reports is calculated. Mathematical caution.
Yeah.
Managing risk requires acknowledging the vast delta between the current speculative market capitalization and the actual on-chain economic activity. It dictates a strategy of highly diversified, measured allocation rather than just, concentrated exposure.
So, bringing all of this together for you, we have tracked a historic $4.9 billion institutional wave, bypassing the retail noise and flowing straight into regulated infrastructure.
It's been quite the journey.
We've mapped how the impending Clarity Act is vaporizing the regulatory risk premium, allowing corporate compliance officers to finally approve these massive allocations.
Right.
We have explored the macro pivot toward algorithmic scarcity as a defense against fiat debasement and the incredibly ambitious goal of utilizing deep liquidity to tokenize global asset markets.
But we also cover the flip side.
Yeah, we have also stared down the barrel of severe concentration risk, complex global AML friction, and the critical difference between high asset prices and actual ground-level utility. It is undeniable that you are watching an entirely new asset class institutionalize in real time. The wild river is absolutely being tamed by Wall Street's concrete.
And this evolution leaves you with a really profound contradiction to process.
Yeah, tell them.
The digital asset ecosystem was born out of the 2008 financial crisis as a direct, cryptographic rebellion against the traditional banking apparatus.
Right, the original cypherpunk vision.
Exactly. It was explicitly designed to bypass the very institutions that are now constructing aqueducts to pour billions of dollars into it.
Wow, yeah.
So, if this technology successfully achieves its ultimate goal of becoming a heavily regulated, completely stable, and fully institutionalized asset class, operating with the exact same custodial friction as the legacy systems it was meant to disrupt, does it ultimately lose the rebellious, decentralized essence that generated its value in the first place?
It is the ultimate systemic paradox. Does winning the institutional game inherently mean losing its original soul? Are we fundamentally democratizing finance, or are we just rebuilding the exact same Wall Street machine, but with faster, more efficient digital plumbing?
It's something to really think about.
It is, and that is the question you will have to evaluate as you watch the Clarity Act vote unfold and track where these billions of dollars pivot to next. Keep your curiosity sharp, keep challenging the consensus, and we will catch you on the next deep dive.